How does an investor assess one's risk, Ashish? Because, we all say at the end of every communication that, there is risk in any market instrument that you invest in. But the basic concept of risk, it's very difficult for people to understand how much risk I can take. So when the going is good, I can take a lot of risk. But when the going, goes southwards, as we've seen recently, suddenly the whole definition of risk changes for an individual. So how do you assess risk? According to you, what should an investor be doing to figure out how much risk she can take?
See, I think that a lot of people attach too much of importance to their psychology when they are assessing risk profile. So, for example, a lot of times you hear people making these statements, so what if the market is down 10-20%? It doesn't impact me at all. Now, it's a different story that when the market actually goes 20% down, these people might really be impacted. But I think all of that should be kept aside. I think risk tolerance should be calculated in a very unemotional manner. And whenever I am asked, I always tell people that the money which is there for you, some of whatever money you have, that part of money on which you are not at all dependent for your sustenance, only that should be in equity. Because what happens is all these questions like emergency fund or liquidity or risk tolerance, all of that comes up only when the market goes in an untoward direction. And at that point in time, thinking about risk and thinking about psychological reaction and all is completely irrelevant, because the point is that some risk which you did not think has materialized, and now you really have to think whether it is going to impact you financially or not. So the point is that, its cyclicality is in the nature of equities, and there is no way to forecast how your psychology will come up in a ungainly kind of event. Like a friend of mine, he in fact recently wrote somewhere that emotions cannot be backtested. Only returns and data can be, portfolios can be, asset allocations can be backtested. Emotions cannot be backtested. So I feel that there has to be a very unemotional calculation of risk. And for me, it's very simple. Any money on which I'm dependent for my sustenance, any money which is for my immediate goals, any money which is for me to repay some loans or liabilities, none of that money should ever be anywhere close to equity. And only the money which I can forget about and which is not going to disturb my sleep, only that should be put into equity. When we start getting into our psychological and mental makeup, then we make the whole thing very fuzzy, and those things don't play out as per plan.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.